Good morning, or depending on where in the world you are, good afternoon, and welcome to the McGuire-Woods ESG webinar series. Today we're going to do part 4, which is our takeaways and wrap up on what your company should be doing on ESG. As a reminder, we will be applying for CLE credit for today's presentation, except not in South Carolina, unfortunately, because they require a 60-day advance notice that we were unable to provide. But if you are an attorney, we will be asking for CLE credit for this presentation. As I mentioned, this is part 4 and the last part in our webinar series that has been ongoing for the last month. If you missed any part of the series, you can, on the link in the slides below, go to our website and you can watch. All of these have been recorded. So you can feel free to watch anything you may have missed or rewatch something that maybe you particularly found helpful. You'll also be receiving a copy of the slides today. Will be emailed out to you. The last thing I want to remind folks about is that there is a Q&A box, and you should feel free to ask any questions that you may have at any time. We will answer them at the end if time permits, but if we are unable to get to your question, we will save them and we will reach out to you by email to make sure that it gets answered. And with that, I'd like to talk a little bit about what our agenda for today is going to be. Really, this is a synthesis of the 3 webinars that have come before. And what we're trying to do is really distill it down to the key takeaways for what is it that your company really needs to be doing and needs to know. There are 5 presenters today, including myself. Also, Katie DeLuca from our Richmond office, Mark Nadeau from our London office, Lizzie Hogan, who is in Washington, D.C. with me, and also Penny Zacharias, who is in our Pittsburgh office. The 5 of us comprise the executive committee of the firm's ESG task force. The ESG task force has more than 100 professionals who have experience in ESG matters, and we are the 5 folks who oversee this effort and have varying different areas of expertise. And it is the 5 of us who will be presenting today. I'm going to start out broad and just do a quick overview of what is ESG, why do we care, and what are the litigation pitfalls that you should be thinking about that you want to avoid. Then I'm going to pass it over to Katie, and she's going to talk about the SEC and best practices for disclosures. And then Lizzie is going to talk about enforcement risk and investigation preparation, followed by Penny and Mark, who will be talking about finance issues with ESG and investing issues, both from a United States perspective and from the international perspective. And with that, I will kick us off with the overview. So everyone is talking about ESG, and it's a big buzzword right now. We all know that it stands for environmental, social, and governance, but really it's something that has evolved over time, starting with the E, with the environmental. The initial focus of what grew into ESG was environmental, and it was focused on climate and sustainability. But that umbrella has only grown, and it has moved from things in the environmental realm, like what are your greenhouse gas emissions, sustainability issues, waste issues, into now social issues. For example, what are your safety practices? How are you handling human capital within your company? How are you interacting with the community in which you reside and the communities where your company does business? Then there is the G piece, governance. What is the composition of your board of directors? Is it diverse? What are the things that your shareholders are demanding that you be doing on the environmental and social side? What are the management and internal controls that you have in place to be able to meet your ESG goals? And finally, how transparent is your company in terms of what it's doing on environment and social goals, and how is it disclosing those items? So why should your company care about this? You know, it would be easy to sit there and say, well, a lot of people are talking about this ESG thing. Maybe I don't care about it. But you do have to care about ESG, because what you're seeing increasingly is that the importance of ESG to shareholders and to investors is going to drive your company to have to, care about this. And companies are receiving ESG grades from, rating services on how well they're doing. And it can impact things like your access to capital. So, for example, we have seen where institutional investors are pledging to divest shares in companies that don't disclose their ESG data. Lenders are being pressed to end the financing of greenhouse gas emissions. And then you have activist investors who are coming in, buying shares of companies, and are putting forth shareholder resolutions and driving an agenda to eliminate investments in things like coal and other fossil fuels, to emphasize the need for companies to be thinking about how to, lower their carbon footprint, how to invest in ESG measures. They are pushing to secure board commitments to climate action. In some instances, they are pushing to have more activist members on the boards of directors and rejecting directors in their votes who they feel are not focused enough on ESG. They're also working toward pushing companies toward when are they going to reach a net zero goal? What are the ways in which companies are thinking of doing that? So those are reasons, the access to capital and the finance and investors, that are all good reasons for why you need to be paying attention to ESG and why ESG is really important. There's another reason, though, which is you can be sued in the ESG space if you're not careful. And so I quickly wanted to repeat as a key takeaway a very high-level view of what companies should be doing to avoid being a defendant in a suit involving ESG. And my number one rule is that whatever your company is saying, your actions need to match those words. And if you keep that in mind, that will be, it's very simple. Actions should match words will really, really help. So, for example, if you promise something to your customers, then you have to deliver on that promise. And you may recall that in the second webinar series, we had a lot of discussion around cases where companies have been sued. So, for example, if you talk about the fact that you are ethically treating cows and chickens, you're a poultry company, you need to be doing that. Otherwise, you can be sued. If you're saying that your tuna is dolphin safe, then it needs to be dolphin safe. If you talk about the fact that your oil products reduce greenhouse gases, then you're going to be hauled into court and have to back that up. If your company knows about something material internally, then you need to honestly disclose it. So, for example, if you do an audit of this is an automobile manufacturer that this example comes from. If you do an audit and you realize that something's wrong with the emissions control systems on your car, you need to come out and disclose that. There was another example of a clothing company that had a lot of internal documents concerned about the effect that warming was going to have on their sales of cold weather gear. They did not disclose that to their investors, and then they got sued for it. So, if you're thinking about something material within your company and you're concerned, you need to be thinking about how to disclose that. Anything you say publicly has to match whatever you're talking about internally. So, for example, If you talk about this is our company's approach to investing, then your actual investments need to match that. If you claim that you're adhering to some type of a global framework for sustainability and greenhouse gas reporting, then you need to follow that framework. And there are a lot of different voluntary frameworks that we talked about in the first webinar. If you claim that your company is doing something in the ESG space, then you need to make sure that your internal policies and your procedures are actually directing that those things are be done the way that you're claiming that they're done, and that there's not a disconnect between those two. And importantly, you need to make sure your marketing materials are updated. We have seen instances where companies, say, for example, have an ESG fund that they're offering and it's no longer available, but you still have that as something that you claim that is available, then you need to, make sure you stay on top of that. You can be sued for that as well. You need to make sure that anything you say is not potentially misleading and couldn't accidentally mislead investors. So while in some instances puffery, can be used, it should not be used on anything ESG related. You need to be very, very careful when you use any words like green or sustainable. When you're using those words, you need to ask yourself, what are the data and the criteria that we are using to be sure that this is in fact the case? That you can answer that question if someone asks you, why do you say this is green? Why do you say it is sustainable? Importantly, and we see this a lot, you really need to be sure that all areas of the company are coordinated in this area and that the right hand knows what the left hand is doing. So you don't want to have, for example, your sustainability officer out there saying one thing and the CEO saying a different thing. And then finally, there's been increased scrutiny on political spending and whether that's in line with the company's ESG commitments. So you need to give some thought to that. Another area in which we're seeing increased scrutiny is on the trade associations that you're a part of. And thinking about whether those trade association memberships and the positions those trade associations are taking match with your ESG commitments. So as I said, that was more the broad umbrella. And now we're going to drill down and get a little more specific on securities liability in this area. And I'm going to pass it over to my partner, Katie.
Thanks, Allison. And as Allison mentioned during our first webinar, we spent a lot of time talking about how ESG factors are increasingly driving finance and investment decisions, but then also how this new trend is expanding the traditional view of what types of information could be material to a reasonable investor under the securities laws. And the bottom line, essentially, is that companies need to assume that materiality is no longer limited primarily to financial information, which has been the longstanding view. And that depending on the company and depending on your industry, it now could include a variety of ESG topics because investors are making voting and investment decisions on those topics. And it's pretty clear, the majority, not all of the commissioners, but the majority of the commissioners on the SEC full-heartedly embrace this new view of ESG materiality. And this is reflected in both its extensive rulemaking agenda on ESG, as well as its new enforcement task force that it's created that is dedicated to identifying ESG misconduct. So this new status of ESG information as being material potentially has made it very challenging for public companies to determine what information on ESG they should include in their SEC filings. And it's also magnified the risk around voluntary ESG disclosures that both public and private issuers of securities, if ESG information is material to an investment decision, or a voting decision, as Allison was referencing, then companies and their officers could be held liable for ESG disclosures that are incomplete or potentially misleading under Rule 10b-5. So I thought it'd be helpful to talk about some best practices and to describe them under 3 specific goals, and we'll go over each one of these briefly. The first goal is, what should public companies be doing now while we wait for some new rules and guidance from the SEC about, what is material when it comes to ESG, and and how this is impacting, how this maybe is impacting your SEC, filings, because the SEC definitely thinks people are not doing enough. Or companies aren't doing enough at this point. So the first step that I recommend is that you carefully review all the public statements that have been made on behalf of your company to date regarding your various ESG topics, and ask if any of these statements have been characterized as specifically, if a specific ESG topic has been noted as being critical or somehow material to the company's growth or future performance. And if you have done that, then you need to address those topics also in your SEC filings. And the SEC is looking, and they're checking these things. Second, I also recommend, especially for people who are new to making ESG disclosure, to not get too far ahead of SEC-mandated disclosure. While lots of stakeholders are asking for various ESG information, I would avoid, unless it's material, and for each company that materiality analysis is going to be different, but just because it's important to stakeholders doesn't necessarily mean it's material to the future performance of your company. And you have to draw that line carefully and put some of those disclosures possibly on your website instead of in your SEC filings. And then also, as you try to determine where to draw that materiality line and what to include in your SEC filings and what to disclose elsewhere, I recommend that you dust off the 2010 guidance that the SEC published on climate change disclosure, and it's a useful tool for any ESG topic, really. And then also to not forget guidance that came out in 2020 that the SEC published about non-financial measures that companies report and decide to include in their MD&A. In fact, if you take a look at that guidance and you applied it to all of your ESG disclosure, no matter the context, that would go a long way to protecting you or your company against possible liability around ESG disclosures. So second goal is what can both public and private companies be doing now in order to protect against 10b-5 liability around their voluntary disclosures. And as you write new ESG disclosure, it's just important to step back and think about how you're describing it. And if you're describing it as being material, just being, again, very careful where you draw that materiality line. And as Allison was alluding to, clarity is also extremely important. For example, if you're disclosing Scope 3 emissions, or if you're making a commitment to reduce Scope 3 emissions, which gets to which we also described what Scope 3 is in our first presentation, how the company defines Scope 3, which standard you're using, and how a reader or an investor may interpret Scope 3 emissions could be completely different. And so it's important that you define your ESG terms so that you can, so that an investor doesn't get a different impression and, claim that your disclosures were somehow misleading. They're not GAAP, right? You almost need to think about it as like when you're disclosing non-GAAP financial information. Are you explaining carefully? Is there any chance that it could be misinterpreted? And then it's also important that your disclosures are accurate and consistent, and that you've set up an internal audit function to make sure that those numbers are accurate, that the data is being collected consistently, and that the information, in different contexts, whether it be your SEC filings, press releases, sustainability reports, that they all match up and are telling the same story. So then finally, how do you adopt ESG goals safely? And this is, I think, an important topic because a lot of companies, as Allison alluded to, are setting up and are being, pressured, to adopt some very aggressive goals regarding their carbon emissions and other ESG topics. And this is a little bit tricky because, a public company would never would avoid at all costs, I think, trying to say what their earnings are going to be by 2050. And yet they're stepping out and saying what their emissions, for example, that they're going to reach net zero. And net zero could mean scope 1, scope 2, and scope 3. You're seeing what net zero means expanding. And so it's important to do that carefully. And to do that carefully, I strongly recommend that you take the time to describe to the public, when you're making these statements, describe the items that are out of your control. Is it the development of new technology, or is it going to be dependent on supportive legislation? Are you going to need customer buy-in if it means your products or your services the costs are going to increase? There's just a lot that the company can do, but there's also a lot that the company is going to need other outside forces to line up to help in order for you to obtain those goals. It's important to note those. I also strongly recommend that companies review their risk factors in their offering documents, and if you're an SEC registrant, in your SEC filings, to make sure that you're clearly identifying in your risk factors the risks that are going to impact your ability to meet your ESG targets. There are two ways to do that. First, you could take a look at your current risk factors and add in, make it clear that those risks apply equally to your ESG goals as they do to your financial goals. But if you've already adopted a net zero goal, for example, or set some ambitious ESG goals that are important to your investors, then I recommend that you seriously consider having a standalone risk factor that specifically address risks that could get in the way of you being able to obtain and reach your ESG targets. I also recommend that you include customized forward-looking statement disclaimers in all of your ESG disclosures. That includes your SEC filings, obviously, but your press releases, your sustainability reports, and on your websites. Because a properly drafted forward-looking statement disclaimer can provide you a lot of protection, as long as that disclaimer is tailored. It's a tailored disclaimer that definitely makes it clear that you're including your ESG targets, and that if you reference some of the factors that could prevent actual outcomes to be different from your forward-looking statements. And then, my final statement, and then I'll pass the floor along, is to just be prepared for change. As Allison was saying, as your ESG story changes, to make sure you're updating it on all your different platforms, and to be prepared for change. No company knows what they're going to look like 10 years from now. And that's going to, as your company evolves, that's going to impact your ESG goals and your ESG disclosures, and even how you define those terms. And so it's just to continually look at those and be prepared to explain how they've changed and how they've been impacted by those items. So with that, I'm going to go ahead and pass the floor along to Lizzie, who is going to describe what you should be doing in case some of these potential ESG pitfalls and risks come to fruition.
Thank you, Katie. So rather than recap all of the various enforcement activity that we described a couple of weeks ago in our last presentation, since we're talking about practical takeaways this week, I'm going to spend a few minutes talking about two key issues that should be top of mind in this current ESG environment. And that is companies' whistleblower programs, and also what to do when and if you get a whistleblower complaint and or an SEC inquiry or subpoena. So to recap two sort of recent points that have come up, I won't go through the whole timeline, which went back to the 70s in my last presentation. In March of last year, as Katie just mentioned, the SEC created an ESG task force within the Division of Enforcement to specifically look at ESG-related misconduct. And there's a couple of things from that I want to highlight. It's 22 people wide, or at least it was when it was announced. And they're really set on analyzing disclosure and compliance issues relating to investment advisors, funds, and ESG strategies, as well as public company disclosures in this space. But importantly, and why I raise it today again, the task force is charged with evaluating and pursuing whistleblower complaints on ESG-related issues. And to highlight the SEC's interest in receiving those complaints, that announcement actually included a link to the Commission's online portal, which is used to submit online ESG tips, referrals, and complaints. So this is top of mind to them, and there's a definite nexus with the whistleblower concerns that the SEC is focused on. Similarly, in April, just a month later, the Division of Exams put out an ESG Risk Alert. And in that one, they were focused on the observation of poor and effective practices largely used by investment advisors. So this wasn't as broad as across the board for public companies, but looking more specifically at investment advisors in that risk alert. But they said that they're going to continue to evaluate whether firms are accurately disclosing their ESG investing approaches, whether they've adopted and implemented policies and procedures and practices that accord with those ESG-related disclosures. This means that there have already been routine exams in this space, and there's likely deliberations going on right now in enforcement about what's going to be escalated to enforcement or whether similar targeted sweeps and examination processes need to be sent out to cast a wider net. I want to highlight a few of the key examples of the poor policies observed by the staff because it comes into play and connects to what Katie was just saying. And that is they focused one on portfolio management practices that were inconsistent with the ESG disclosures. They found companies that were not adhering to the global frameworks that they said they were adhering to. They found that there were fund holdings that were predominated by issuers that had low ESG scores, even though they claimed to be ESG-related investment strategies. There were also inadequate controls found in ESG investing, and inadequate controls in the ESG disclosures and marketing that Katie was just talking about. They also did find some potentially misleading claims. They were observed in a lot of different contexts, including the marketing materials of ESG-oriented funds, firms puffing or their otherwise inconsequential role in contributions to developing those ESG-oriented funds. Those are ones to sort of think about what, if we're reading the tea leaves, what might be going towards enforcement next. That's probably fair game. But also they found ineffective compliance programs, and that some firms lack policies and procedures addressing their ESG investing analysis, their decision-making processes, and their compliance and oversight review. And obviously that's very easy to take away from the investment advisor context and apply it more broadly to public companies who are engaged in ESG activity more broadly. And that leads us to the Whistleblower Program. So if the SEC is actively soliciting whistleblower input on these topics, it's certainly something that we need to watch. So since the passage of Dodd-Frank, which obviously we all know added in financial incentives and anti-retaliation procedures for putative whistleblowers to the Exchange Act, the SEC now receives very frequent communications from employees, investors, from short sellers, and from other members of the public on all of these issues. And as we saw, now this is an area where the SEC is soliciting this kind of feedback and input from the public and from employees. Right now, we're talking about issues that have new and greater importance to investors. That's also likely very true for your employees, particularly as we're talking about a younger workforce who these are core issues that are driving their investment strategies. It also probably relates strongly to where they feel or issues they care about in the workplace as well. So, and also most of the regulatory activity we've seen so far in this space has been driven by inside information. And whether through formal whistleblowers or tips that have been submitted to regulators, not just the SEC, but to other, the DOJ as well. So we really need to take a careful look at the whistleblower practices within a firm. Just to recap kind of the key highlights on this, 21F of the Exchange Act offers the financial incentives to a person to voluntarily provide to the Commission non-public information that results in an enforcement action. It also has the anti-retaliation provisions, which creates a private cause of action for a whistleblower to sue his or her employee for any form of harassment caused by the employee's whistleblowing activity. And the Commission can also take action against retaliating employers as well. There have been actions that have been brought against public companies for having language in their separation agreements, too, that impeded whistleblowers from reporting information to the commissions. That's also something to look at, and probably better suited for our labor and employment friends who are on the task force rather than myself as an enforcement attorney, but certainly something to look at as the lens is now focused on whistleblowers once again. I'll tick through these really quickly because it doesn't dramatically change it in terms of the need to draw attention, but there is a recent proposal just from last week to amend the whistleblower rules for the commission, and largely it's allowing them to still give to award whistleblowers for actions that were brought to other entities, meaning other regulators, whether that's state or federal, where those awards might have otherwise been paid under that entity's whistleblower program. The SEC has a proposal to be able to compensate those whistleblowers as well. It also kind of restricts what the commission can do in terms of proposals that are put before them, saying that they can only consider the dollar amount of the potential award for the limited purpose of increasing the award amount, but not for decreasing the award. I also want to highlight the states here. New York and California had two developments in the last month. So it's important, depending on where you're located, to be thinking about what are the various restrictions on a state level too. New York, for example, dramatically changed their regulation in favor of the plaintiffs, and largely expanding the definition of an employee, expanding the statute of limitations, expanding what it means to have a retaliatory action, expanding the potential damages and the forms of relief. So, and California recently held that private actions brought in California for retaliation claims are subject to a more plaintiff-friendly and employee-friendly standard within their labor statute, as opposed to the stricter one in the federal circuit. So something to keep an eye on. Obviously, we don't have time today to cover all the states, but it's an area that you need to be focused on. So a few key areas in terms of reviewing your whistleblower program. Your internal reporting framework. Now is the time to take steps and ensure that your current internal reporting framework is robust and it's flexible enough to identify, to respond, and investigate potential ESG disclosure misconduct. Companies that have the ability to conduct a thorough internal investigation and have a really clear response to an internal tip are going to be much better poised to self-correct and to have a defensible position if the SEC or other regulatory enforcement arm comes to bear. Things to think about is, do you have an anonymous hotline? And what's really being done to monitor it? Are the tips being resolved in a fair and equal way? Are any of them being escalated to a senior enough level of management and getting the kind of concern and oversight that they deserve? Are the escalation procedures to the right levels in place that people are actually taking avail of them and not just putting in easily dismissing tips that they're received? Too often, companies, when they get word of a tip, especially when it's just still internal, they spend an extraordinary amount of resources trying to figure out who that person is, if it's been done anonymously, instead of thinking about the actual substance of the claim that's raised, and looking into the allegations immediately to see and to get better positioned to address it if that tip has also been shared outside. For internal whistleblower communications in the ESG space, you have to treat it in the same way that you would treat any other whistleblower complaint, right? Whether it's securities disclosure questions, accuracy of financial reporting, and the like. It's all the same. Most SEC whistleblower awardees, those claims went to a direct supervisor before they were ever reported out to the commission. So companies need to acknowledge the whistleblower tips or complaints that they receive and engage in those appropriate communications if they're not anonymous. That lack of communication following the submission of a tip like that, it can result in misunderstandings, and certainly more often than not will result in a report out to the government. On policies and training, this is a great opportunity to look to make sure your policies and training are up to date. Effective policies need to reflect a zero-tolerance approach to retaliation so employees can feel comfortable reporting internally rather than externally in the first instance. It's an opportunity to communicate your policy back to your workforce again if the training hasn't been held in a long time. And also, it's helpful to target your anti-retaliation training to management where those first level reports might go to as well to bolster the open channel of communication there. Internal reporting for a remote and hybrid workforce is also new to us, right, in the era of COVID. Are there things in your policies and procedures or your training that should be tweaked to reflect our current work environment? There were a record number of whistleblower tips reported to the SEC during the pandemic, despite it being a remote environment. So here's an opportunity to provide clear reporting mechanisms that they instill confidence, and they also include lots of anonymous reporting options. And people might be wary because they're electronically submitted that it could be traced to where they are. It's the opportunity to make clear to them that these are kept entirely anonymous. And last, as Katie mentioned, here's your opportunity to revisit your ESG policies, procedures, and internal controls. If this is going to be those disconnects between public statements and what's happening inside the company are the opportunity for someone to raise a hand and say that there's a disconnect here. Now's the time to look back at those internal control functions to make sure they're operating as smoothly and as intended. So what happens if you get the inquiry or you get the inside tip? There are so many things here. I could spend an entire webinar on them. This kind of looks like a little bit of a whack-a-mole game, so I'll try to hit some of these quickly, just to give a flavor of the different issues that both public companies and financial institutions should be thinking about as requests come in the lens of ESG, of course. But regardless of whether an inquiry that comes in is formal or informal, the company under investigation obviously should take the matter seriously from the outset. Any one of these investigations can lead to an enforcement action if it's not handled properly, and obviously that has significant consequences for the company's finances and reputation as well. The key action items we have here, they highlight ways for a company to focus their efforts in an SEC investigation, in particular from crafting the tone at the top from the very outset. And the first is retaining outside counsel. I know that sounds like a sort of shameless plug, but honestly, these investigations are very complex and they're varied. Having counsel with SEC enforcement experience or investigative experience can be really helpful in navigating those challenges, whether it's on the front line or providing guidance in the background. The staff is more likely to rely on a formal review done by outside counsel rather than one that's done purely in-house, no matter how robust it is, just by virtue of having a slight lens of separation there. It also provides resources to in-house counsel who don't have to forego their entire day job just to handle an internal investigation separate apart from their day-to-day duties. But more importantly, also importantly, it helps preserve the privilege. And there can be complications when in-house counsel has to provide and serve in an investigative role, but also provide counsel on a day-to-day business or provide business advice as well. Having an outside firm or outside party come in and assist in that way better protects those barriers. If it's voluntary or formal, these investigations begin sometimes from insider tips, from review of public disclosures that can come from a number of sources. If it is formal, one thing to keep in mind is to request the formal order from the SEC at the outset so you can get a little bit more information about really what the focus of the investigation is. Sometimes they're quite limited in scope and what they say in the formal order, but you should always grab it to check. I want to touch on legal holds and the preservation of documents. It's well understood that there's a duty to preserve when litigation is reasonably anticipated. What constitutes reasonably anticipated and how it's applied in each specific case and in a different jurisdiction, it can differ and vary. The SEC Enforcement Manual states a duty to preserve generally arises when litigation is reasonably anticipated or foreseeable, as well as when litigation is pending. There are penalties, can be both civil and criminal, for destruction of documents in the course of investigation as well. So obviously this is something to take extreme caution with when you do receive an inquiry, whether it's as formal as a subpoena or just a voluntary request for documents. It's important to consult with counsel to determine whether the duty to preserve evidence has been triggered and what steps you need to take. And predominantly that's the issuance of legal hold. I would also note you should consider the collection and hold on personal devices. given the SEC's focus in this space in the last year on employee use of personal devices to conduct business, especially in our remote environment. For role of individuals, I'll note this really quickly. Whether there's an individual named in the subpoena itself, or if they come to light as more facts are developed and emails are collected as being a key person, need to be thinking carefully about whether or not they need individual counsel. Also, of course, if executives are very strongly involved in the creation and the crafting of these disclosures or making their own public statements on that front, there is a risk of control person liability here too. And so we need to sort through, as soon as you have a sense of what the SEC is looking at in terms of public disclosures and the like, who's at risk here? Is it just the company, or are some of your executives involved, or individual employees as well? Negotiating the scope and the date of response for a subpoena, this is really just an opportunity to get a better sense of what the staff's looking like. Sometimes you'll have a lot of luck starting small and broadening out, but really it's an opportunity to engage and to see if they're willing to shed light about what their true focus is in a way that you can help them get to the bottom of the relevant materials and information faster. Sometimes it's necessary to do a parallel internal review. It's not always required, but sometimes it's in the best interest of the company to perform its own internal review to get ahead of where the regulators are and to see what facts they can learn and to come up with a defensible strategy. One thing to note on this, though, sharing information from the internal review with the regulator, it can benefit in terms of winning cooperation credit, and there's certainly a lot of merit to that. At the same time, it does raise privilege risk that needs to be addressed really carefully. And we'll have to go through a whole analysis of what that waiver might look like and how to avoid it. The same, you also need to identify who the client is in that. Is the audit committee directing that internal review separate from the defense of the SEC subpoena in general? It's also often wise, particularly if there's accounting issues involved, to keep your independent auditors involved. And at the risk of running over my time frame, I'm not going to go into that too much because it varies on the nature of the investigation, but it's something to keep in mind. And then also, lastly, I'll touch on cooperation credit. People always wonder if it still exists and in what form. I think it's interesting that the SEC speaks back in 2021 last fall with the new administration. They noted that they're going to push down a lot of the enforcement choices and responsibilities down to the line level attorneys that are working on the case, those closest to the facts and circumstances of the individual investigations. And that includes whether or not to accept white papers in advance of the wells, whether the deputy director and the director will even attend the wells meetings, but also, importantly, whether or not cooperation credit is merited here. And what's interesting is just last week in a recent ESG-related case, the SEC alleged that and it was a settled matter. So the SEC found that a robo-advisor had claimed its investment strategies complied with Sharia law. And it included some language in cooperation in their settlement papers on this, giving some promise that not all is lost on the concept. That's in the matter of Wahed Investments. And they found that the robo-advisor had claimed to be compliant with Sharia law, but they didn't have the policies and procedures in place to back it up. They layered a $300,000 fine on the firm, and they required a whole revamp of its compliance program through an independent monitor. Interestingly, on the cooperation point, I'll just highlight how they framed it. The order found or noted, following identification of certain issues by the commission staff, Wahed Invest located its marketing department to the United States for closer oversight by its U.S. CCO. They replaced its advisory firm on Sharia law, took additional actions to improve its compliance policies and procedures, and throughout the investigation, voluntarily met with the staff on multiple occasions and provided factual summaries of the relevant information. Again, the balance of doing an internal review and reporting out to the SEC can win you some favor in this regard. It is a $300,000 fine, which seems a little bit low in connection with some of these kind of material misstatement cases. However, they also have an independent monitor as well, which can be extraordinarily burdensome. So query how much the cooperation credit got them in the end, but it has been noted in the order, so it's interesting to see that it is still alive. I have a few others up there on the slide, but I'm going to pass the torch on since I've gone a little bit long. But we're happy to answer questions, as they come up, or if any of you find yourself in this scenario and want to talk through these issues, we're here to help. And with that, I believe I'll pass it on to Penny.
Thank you, Lizzie. Well, good to be with everybody again. I'm just going to do a quick overview of what to expect entering into a transaction, a financing transaction or investment with an ESG overlay, both from the company and from the borrower and the lender or investor perspective. So, as a business, if you haven't been, accessing or considering green or social financing yet, there's a likelihood, a decent likelihood that you may in the future. We've seen a lot of barriers that needed to be overcome before both green and social finance is really considered mainstream, but it's certainly, if what we've seen over the last 5 and, probably even more at an accelerated pace, two years, it certainly seems like the momentum is there. Certainly. And the momentum is driven by this wider environmental, social, and governance agenda that, my partners have been talking about in this series and the other series as well, the other webinars. We've seen businesses that have set specific ESG related targets, whether that's, related to greenhouse gas emission or renewable energy or workplace safety, employee diversity, business ethics, a whole host of different reasons we're seeing driving this demand for the green and social financing. And, we've also seen that some financial institutions are requiring their customers to adapt ESG frameworks. So that's also led to the advent of the popularity of some of the loan products that I've talked about before, and I'll just review very quickly here. We have green loans, sustainability-linked loans, social loans. The green loans and the social loans really have taken on a very similar structure, with the main sort of fundamental feature being the use of proceeds of those loans, whereas the sustainability-linked loans tend to deviate from that model and involve a focus on sustainability performance targets. Sort of specific measures that a company can take. It could be a specific project. It could be, multiple aspects of the business. In sustainability-linked loans, if those targets are met, then the company may be able to be rewarded with a ratcheting down of its interest rate, for example. So, there are clear benefits here in these structures that lenders are providing now. The array of considerations for lenders and borrowers is, sort of follows a similar strain. I've talked about the use of proceeds already and how if a company's entering into one of these structures, green or social loan, it really will have to clearly identify what those green or social projects are that are going to, benefit from the use of the proceeds. The structure of the loan, both lenders and borrowers can think about whether a term loan, a revolving credit facility, some other structure, maybe both or multiple credit facilities to be provided by the lender are going to be necessary to achieve the objectives of the company or the needs of the company. For example, we see a lot of the sustainability-linked loans take the structure of a revolving credit facility. Those are facilities that are periodically drawn upon and repaid when needed, which is a characteristic, means that they're sort of suited to a more flexible general corporate purpose loan, which goes well with sustainability-linked loans. Just one example. Certainly, this is by no means completely teased out at this point in time, but other considerations that a lender may have are, what the impact on pricing will be, how they're going to get the loan underwritten with the ESG overlay, the structure I just talked about, what the consequence may be if the sustainable terms in the loan documentation are breached, what that might mean for the institution itself. Is there going to be any type of reputational risk associated with the institution that really dives into this, this aspect of lending? how they're going to look at complying with and the ongoing monitoring, of the social or green components of the loan. If it's a large loan and the lender can't hold the entire commitment itself, how it's going to go about syndicating, creating a syndicate with other lenders. On the borrower side, the company will have to assess the sustainability framework and sort of what the overall cost of compliance within that framework is going to be to the business versus benefit of entering into one of these facilities, what type of pricing benefits it may be able to achieve by, for example, hitting its sustainability performance targets in a sustainability-linked loan, what the risks and consequences for the company may be if it breached one of the sustainable terms, what additional documentation is going to be in place, what's that going to cost them, is that going to draw out the process, will the company have the ability to self-monitor and report and engage a third party to verify some of these components if that's being required of them by their lending partner. There's certainly an element of reputational risk for the company as well for failure to comply with these terms, and just ongoing reporting and disclosures. A lot of the latter piece, I know Katie and others have talked about at length. Certainly, depending on the company, it could have real ramifications. So one other aspect of the financial markets, just the private equity sector, we haven't talked a whole lot about that, but that is a very large growing interest from private equity firms, this whole entire space in investing in ESG. There's just a much greater conviction among a lot of limited partners and fund managers that sustainability is going to create greater value over time and generate greater returns on these investments. I think we saw it's been a growing trend for some time, but in the wake of the 2020 pandemic, we did see record-breaking pools of investment capital being poured into ESG funds as a way to profitably combat a variety of social and environmental problems. There has been, in some circles, mounting pressure from limited partners to minimize risk in this space and really more squarely align their values with those of their portfolio companies that they're investing in. So just some stats here. ESG funds have exceeded $1 trillion for the first time during the COVID-19 pandemic. The Financial Times has reported that a majority of these funds outperformed the S&P 500 during the first half of 2020 in the wider market over a 10-year period. Global ESG assets under management grew from $6 billion in 2015 to $150 billion in 2020. And in that same time frame, the overall impact of both private equity and venture capital fund assets grew by 154% to $28 billion. So, sort of wide sweeping movement in a shorter period of time. Again, whether or not COVID-19 was a direct driver or the sole driver, I think it's certainly, we can see that 2020 put ESG on the mainstream investment map in a very meaningful way. And, at the same time, there is this major transfer of wealth that's been occurring in our markets, and a tremendous focus on sustainable investments. So, again, just sort of fostering that momentum, the goals and the mandates of ESG private equity investing, largely motivated by limited partners with a true, genuine interest in this space, also coming from pension funds that are focused on longer-term ESG funds, longer-term ESG investments with just an eye towards scale, credibility, standardizing the data that's viewed and the disclosures that are required by the portfolio companies. So a lot of movement here. We know that there's considerable room for improvement just in terms of having a consistent process and, by no means firms are taking very different approaches in this space. So we expect to see a lot more future activity there. Just taking a step back, why would a company want to seek one of these loans or investments? Clearly, they need to secure capital, whether that's for a particular project, for a longer term period of time. But first and foremost, then looking to minimize overall risk associated with entering into a transaction, and also seeking to gain and enhance the overall profile, their overall sustainability profile. And, there is a huge reputational piece here. Again, you've heard from some of my partners what could go wrong. If your actions don't clearly align with your words that you've used in terms of what your company does, or, what your objectives are. So, I think the reputational piece definitely goes both ways in this lens, that, the reputation of your capital provider partner is going to be tantamount to the success of the transaction, and the commitment of your capital provider, a genuine commitment in the ESG space versus just window dressing or marketing, will really be important as to whether or not there's going to be a lasting impact with your transaction. We know there's risks associated for both parties, sort of for window dressing or greenwashing or social washing, or some terms we've talked about before. I will just summarize with saying we really believe there's going to be a bright future for ESG in the financial markets here in the U.S. We think there are going to be a lot more entrants looking at this very creatively, with really innovative solutions to very targeted projects. We know that companies have started to develop really sophisticated approaches in the E component of the ESG. We expect to see a lot more of that with the S and the G components as well. We know that political and social events are key drivers with this change, so certainly a lot more at play here. But very excited about what will be coming in the months and years to come. That is all I have on the U.S. piece. I wanted to compress remarks in the interest of time, so I'm going to turn things over to Mark.
Thanks, Penny. So following on from my last stint on the webinar, I spoke about investing in Africa through ESG products. So I thought what would be a good approach to my kind of quick wrap up of the webinar is 3 points on each side, lender and borrower, in terms of what you should be looking for when investing into Africa. And these considerations are aimed to be more practical. And given that it's going to be a high-level overview, I do encourage each of you, if you have any further questions, to reach out directly to me or any one of my colleagues. So as a lender, the first thing you want to look for when identifying an ESG transaction is the track record of the jurisdiction that you're looking at. So usually it goes in two ways. The first is you look at the number of deals, the volume that's in that jurisdiction. And you should also be very careful to monitor market trends. For instance, a few years ago, AFDB as a lender was doing a lot of work in Nigeria. And if you can catch that wave, it's an easy way to get into a jurisdiction that's with a lot of private sector capital in it. And with the track record, you also look if there's a DFI, a development finance institution that has a country office in one of those jurisdictions. Bearing in mind that sometimes going for the less risky jurisdiction isn't always the best, because the less risky a place is, the more competition there's going to be. So for instance, look at South Africa, look at North Africa, where the finance market has been developed and a lot more competitive. and they don't operate under foreign law, so South African law. And in North Africa, they operate under maybe sometimes French law, but mostly their own local laws. You would also have to look at collateral considerations, very important. Can you extract assets out of the country? Can you monetize them to the extent a borrower defaults? In this regard, there's numerous cases of places. It used to be Angola that was the place that you didn't want to take collateral in, and now it seems to be Mozambique, so just be aware of that. And also exchange control approval in terms of getting money out of the country. So generally any payments made by a borrower to a lender would have to go through a reserve bank process or central bank process. I mentioned this in my last webinar, that you should also try and look for DFIs and whether you can include them somehow in a transaction. It generally makes the transaction safer because DFIs do have a degree of political influence when dealing with corporates in certain jurisdictions. However, what I would say is they are policy driven, and from a very practical point of view, a transaction that involves a DFI will take at least 3 to 6 months longer than a normal transaction, as it is a very slow process to get through the policies as well as the various levels of command within a DFI. But back to the positives, they have the golden goose, which is the PCS status. And PCS, for those of you who don't know, is preferred creditor status. And that means that as an institution, they have access to dollars within the country. So if there are dollars in the country's reserve, people with PCS status have access to those dollars first, and that mitigates currency risk when going into these transactions. And lastly, you would look at the industry and sector being funded. I would encourage lenders and those of you that are lenders on this call to ensure that your ESG internal protocols matches what problem you're trying to solve for. There's two approaches to ESG lending. The first is what we call the purist approach, which is a pure ESG loan where the use of proceeds are used directly to a sustainable project. And the second approach is where it's a general corporate loan with an ancillary ESG component that is not linked to the actual project that's being funded. And that could be community upliftment or building a school or whatever of that nature. There's no right or wrong approach to it. Generally, one shouldn't be chastised for doing the right thing, irrespective of how you get there. But what I would say is, as a lender, ensure that your ESG internal protocols are robust enough to include what you are trying to do. And it goes back to what my colleagues were saying earlier, which was do what it says on the tin, make sure it is. And so if you are saying that you have a portfolio of assets that are X, Y, and Z, ensure that your internal policies are robust enough to include them. And this would generally follow the same spirit of the EU taxonomy, which has quite a broad definition of sustainable finance. So moving on quickly to borrower side considerations. The first thing is I sound like a broken record because I think I harped on this in the last webinar, but you need to have an appropriate risk mitigation strategy, and this would include a pre-agreed DFI engagement. And by pre-agreed, it's not the lender that de-risks your structure, it's the borrower. You will have to go and source a DFI with the business plan and ask them to help you de-risk a structure in order to crowd in private capital. And this goes to the $1, $4 analogy, which is for every $1 that a member of the World Bank lends, it's actually equal to $4 of private capital where that World Bank member guarantees that debt. And that is how you crowd in private capital into a system. So the one consideration as a borrower that I would give you, because we are working on a transaction at the moment and we are lender side, and I genuinely feel bad for the borrower on this one. But you need to ensure that the DFI that you engage matches ideologies with the lender that you are looking for.
because what will end up happening is you will have a set of covenants from the DFI side and a set of covenants from the lender side. And if these are not matching, you're going to end up with a legal agreement that's the size of the Old Testament, and with two sets of information covenants that your administrative staff will not be able to manage. So ensure that there is some kind of matching at that level before you approach a lender. But first port of call should be approaching the DFI. The second practical consideration is collateral and what you give up as collateral. Usually in emerging markets, and it goes back to the lender consideration that I mentioned before, where we discussed that some jurisdictions are regarded as risky with regard to collateral, is cash is king. And usually lenders like to see collateral being given in some form of cash way. This could be through a debt service reserve account, which can be set up offshore. This also links back to the PCS status regarding dollars leaving the country and exchange control approval. Or it could be a clever use of a cash sweep, taking into account the specific nuances in African jurisdictions where there could be payments that are statutorily higher ranking than what the payments to the lenders would be. But what I would say is you should mitigate that credit risk upfront before going into long-form documentation. Otherwise, you'll be chasing the rainbow road, changing terms, new security documents, trying to figure out a way to make lenders and DFIs happy, when if you could just agree it upfront, what would be the appropriate collateral, that's always the best. And that's probably in life is the best approach to have, not just with financing in emerging markets. The last thing is a very practical point, which is quite actually funny that I'm mentioning it, considering that I'm an attorney myself. But you should look at the costs involved in a transaction where you are de-risking. And these can build up as a borrower. And some costs you might not even think, wouldn't even come into your contemplation at the beginning of a transaction, suddenly are sprung upon you. So, for instance, you would have to pay for your legal counsel. You would have to pay for the DFI's legal counsel. You'd have to pay for the lender's legal counsel. If there's a security agent and a facility agent, you would have to pay for their legal counsel as well. You have to cover the cost of local counsel across all the jurisdictions that you're working and the nuances that come with that. And the main thing as well is the third-party verification from places like Sustainalytics, where that is also a massive cost and a burden. So the way I would mitigate this is to agree a structure up front that is not likely to change. And so then you have some kind of, the devil that you know in terms of how much your cost will be, as opposed to you learning on the job. And this goes back to the collateral point, which was to have an agreed structure up front that you're aware of and you can work towards. As I said, these are very practical points, and just aware that we're over time. So I would say that if you'd like to engage further on this and understand more, and if you've got something in Africa or a business proposition that you're looking at, come and chat to us, and we'll talk you through it. It's not as scary as people think. And there's interference on the Okay, well, I guess that's the universe's cue to tell me to hand over to Alison for the wrap-up. So thank you, everyone.
Thank you, Mark, and thank you, everyone, for hanging in. We're sorry we ran just a few minutes over, but we hope you found the content really valuable in this important area for your company. We did see that some questions did come in through the Q&A function. We obviously don't have time to get to them. I'm sorry, but we will, I promise you, respond to each question via email. As you've seen, there is a lot to discuss here, and we've done all of this at a pretty high level. as on one slide, I think it was Lizzie said, this slide alone could be a 1-hour discussion. We are available for more fulsome discussions should your company want it on any of these topics. And we're also, of course, available to assist with any ESG needs that you may have. We do have an experienced team of over 100 professionals who are able to handle any different aspect of ESG that you may have. These are the 5 of us that comprise the Task Force Executive Committee here at McGuire Woods. Please feel free to reach out to any of us with any questions, comments, or anything you may need. Any of us will know who the correct professional is to assist you. And with that, thank you very much. And again, we will be asking for CLE credit. Thank you.